Hi everybody, we're back. So chapter 19, we're dealing with break-even analysis. I'm just going to go through a quick example of 7 different scenarios and then decide would we recommend this proposal. And break-even helps companies realize, okay, if they're doing as is with no changes, what is their break even? What if they decide to change things up? What will happen? It just gives them a nice idea of where they're going to be. So on this example, BG company operating full capacity sold 150,000 units at a price of $116 per unit. This is their current year income statement, sales, cost of goods sold, gross profits, expenses. You notice on expenses they just have selling and administrative, and their cost of goods sold is just a flat number. Well, here they're telling us cost of goods sold 80% is variable, 20% is fixed, selling 75, 25, 70, 30. And then they're also considering a planned expansion program. It'll increase their sales to $3,625,000 and fixed costs by $1 million. So we're going to go through 7 different calculations and then we're going to decide, is this really worth it? Okay, so the first one is determine the total variable cost and the total fixed cost for the current year. So number one, so for total cost of goods sold is our $6 million. Selling expenses were $4 million. And administrative was $3 million. And on this one, they want to know what percentage of that is variable. So I brought in my 80, my 75, and my 70. So I take my 6 million times my 80%. That gives me 4.8 million for cost of goods sold for variable. The 4 million times the 75%, and the 3 million times the 70%. So then my total variable costs are 9,900,000. So then if we wanted to look at our total cost for fixed, let's get enough zeros. Nope, I didn't think I got enough zeros in there. So we have 6 million. Bring in those costs over again. Now there's a couple ways of doing this. You could just take your 6 million minus your variable to get your fixed cost. I'm still going to, just for consistency, use the percentage. Well, 80% plus 20% is 100, so make sure those equal 100. So I take the 6 million times the 20%. I'm just going to copy that formula down. Okay, and then we'll add those up. So for variable cost, out of the cost of goods sold, the selling, and the administrative, we have 9,900,000. Fixed costs are 3,100,000. So determine the total variable cost and the total fixed cost for the year. Current year, we got it. Now determine the unit variable cost and the unit contribution margin for the current year. Okay, so net sales, that came from our sales, is 17,400,000. Our total variable cost, that's going to be the 9,900,000. Now, if you remember in our reading, contribution margin is the difference between your sales and your variable cost. So the 17.4 million minus the 9.9 million. So our contribution margin is 7.5 million. The number of units, we're at full capacity. So we have 150,000 units. So if we want to find out per unit, we're going to take that 17,400,000 divided by 150,000. We came up with that number earlier. And our 9.9 million divided by the 150,000 units. And again, your contribution margin per unit, again, contribution margin, the difference between your net sales and your variable cost is $50. Okay, so we got number 2 done. So now 3, once you compute the break-even sales in units for the current year. When we want to find out the break even, we need to know how many units we can actually produce to break even, having no profit. So to do that, you take your fixed cost and you divide it by your unit contribution margin. Okay, well, our fixed cost, remember fixed we can't change. Fixed is fixed. So we take the 3.1 million, we divide it by the $50 contribution margin. So to break even, we have to always produce 62,000 units. We earned a profit of 4.4 million when we produced 150,000 units. Okay, so then part 4, compute the break-even units under the proposed program for the following year. Well, if you look on here, the expansion will increase fixed cost by $1 million, but will not affect the relationship between sales and variable cost. So what we have to do here, we have to take our 3,100,000 plus we need to add another million, because by doing this program we are increasing our fixed cost. Divide that by your contribution margin per unit. So now if we go with this new program, we have to break even 82,000 units. Number 5, determine the amount of sales in units that would be necessary under the proposed program to realize the 4.4 million of income from operations that were earned in the current year. Okay, so they're not wanting to decrease that income from operations, so they're saying, okay, how many units do I have to produce now to get $4.4 million? Okay, so what we do here, you take that 3.1 million plus that 1 million, okay, plus we want to have a target profit of $4 million, and we divide that again by the contribution margin. Okay, so what this means is we have to produce to have our fixed costs, remember those increased by $1 million, plus we still want an operating profit of $4.4 million. We divide that by our contribution margin, so now the amount of units, we'd have to produce 170,000 units. We were at full capacity at 150,000 units. So that might come into play when we're discussing number 8. Okay, number 6, determine the maximum income from operations possible with the expansion. Okay, so we'll start with our sales. Well, we will still have sales of $17.4 million. Plus, it will allow us to increase our yearly sales by 3,625,000. I got that number from over here. So that gives us $21,025,000 in sales. Fixed cost with the new proposal, remember that was the current fixed cost plus the additional million that it was going to increase. Variable cost. Okay, so what we have to do with this one, I'm going to do a couple of little calculations here. We need to take our 3,625,000. We need to divide it by the $116. That was your per unit for sales. Plus 150,000 units. and we need to times that by $66. Okay, so that gives you 11,962,500. So what we did here, we're going to increase our sales. If we increase our sales, that will help us. We had to determine how much per unit. We already produce 150,000 units. We're not planning on getting rid of that. Okay, and we times that by, it's 66 units, $66 per unit based on the 150,000. Okay, so that's where we came with 11,962,500. So our total expenses are the 16,062,500. We subtract those two, our sales minus our expenses. So our new income from operations is 4,962,500. So then if the proposal is accepted and sales remain the current level, what will be the income or loss from operations before the following year? Okay, so we had 4,400,000 operations. We increased our fixed cost. Okay, those increased by $1 million. So the difference between those, our income from operations goes from 4.4 million to 3.4 million. Okay, so that's kind of how the calculations go. Now they're saying, based on the data given, would you accept the proposal? One thing I pointed out, we're at full capacity, 150,000 units. To get our target price, we have to do 170,000 units. Okay. Our break even currently to earn nothing, just to have a even out, we had 62,000. With the new plan, we now have 82,000, additional 20,000 units that we are now having to figure out. Now, number 6, determine the maximum income from operations possible with the expanded plant. Yeah, that's 4,962,500, but you're losing $1 million in additional fixed cost. So, is there a yes or no definite answer? No. It just depends on your company. Are you sure that you can handle 170,000 units when you're maxed out 150,000 units? What do you need to do? That's why fixed costs went up. Okay? Are you going to risk having to make an additional 20,000 units? It just depends on how your company sees it. So this video gave you an idea of what to do with break-even analysis. You have any questions, you know how to reach me. Thank you.